Good morning. Welcome to Forex in Four. Today is Monday, December 5th, 2011. All right, so what do we have going on this week? Well, quite a bit actually, and this could be a week where we see a lot of volatility coming out because not only do we have a lot of economic data on the table, especially the type of data that's coming out is GDP data, as well as a bunch of different rate decisions, and I'll run through those in a second. But we also have these meetings in Europe which have held high anticipation for what's going on, and the December 9th Euro Head of States meeting is going to be the big one that people are looking towards. Now, the ECB is actually going to meet on the 8th, okay, which is, what's that? That's on Thursday the 8th, I guess. And they're going to have their interest rate decision. And there is some of an expectation in the market that they may lower interest rates by 25 basis points again. So, we may see that happen. They lowered 25 basis points last time. They may do it again. Okay, they're facing recession over there because of what's going on. Draghi's come in and he's shown that he's wasted no time in cutting rates. So we could see, say, 50 basis points by the beginning of the first quarter there next year. So we could see an interest rate cut in the Eurozone. That's the first thing. But the important meeting is going to be the central bank meeting on the 9th, the one of the heads of state, where they come out and they discuss, all right, what are we doing about this Eurozone crisis? And that's the big thing that we need to look at, because they're talking about fiscal union, all right, but the problem with fiscal union is that, you have to change the treaties over there. That's not going to happen. So there may be some sort of, getting around the whole thing, but just to make it practical, but trying to figure out how exactly to give the European Commission more oversight into the budgetary concerns of the countries that are in question there. All right. Also, the market may want to see them move more towards the idea of the Eurobond. Now, we've spoken about this in a while, but essentially combining all the debt and coming out with one Eurobond for at least a portion of that. Germany's been steadfast against that for some time, but we're going to have to see. I mean, you're getting tremendous pressure on them to get this thing resolved, and they've sort of been dragging their feet for a long time now, and it seems like I'm a broken record when I get on these things and talk about it. But this morning, markets are moving higher in anticipation. You can see here on Friday. Friday we had the sell-off here on the U.S. non-farm payrolls report. All right, even though the headline number for the unemployment rate went down to 8.6%. Okay, the problem was that the participation rate decreased, and a lot of that was due to people who were just discouraged and were no longer looking for work. And I mentioned in the video earlier in the morning that sometimes you're going to see anomalies that happen like that. I've put it in the written draft earlier in the day, but when I do the videos earlier in the morning, obviously it was before that number came out, so it sort of met what my expectations were, and we did end up fading the market. Because you can see there's a little bit of a double top that happened at Euro, just above this 135 area, say 135.30. But we're climbing back up today. All right, I'm going to guess that this 135 area is probably going to act as decent resistance for a little bit here. But we also have tremendous risk-taking going on in the market. S&P's moving higher. Start today, you can see that. We've got gold selling off a little bit here. Okay, you can see gold selling off, and gold's sort of been acting as that risk proxy there. As far as news this week goes, let's just do a quick rundown of what we've got happening. All right, we've got earlier today we had Eurozone PMI figures came in a little bit lower than expected. That was services, the composite, and German index services. Those all came in lower than expected. That's not so great. Eurozone retail sales, though, came in better than expected, 0.4% gain versus 0.1% expected gain, which pushed the year-over-year number to down 0.4% from an expected down 0.8%. Let's look at the pound here real quick. We're just looking at all these on the 30-minute chart. Pound moving higher. They had their PMI index services figures came in 52.1 versus 50.5. That's a pretty big beat. So as I mentioned with the pound, the data belies what they think is going on. It's amazing, but it seems to me sometimes that the Bank of England just sort of is coming up with excuses and ways to keep money easy over there, because the data keeps coming in pretty strong in the UK, in my opinion, given what we're seeing around the rest of the globe. And that's one of the things that we have to remember, is that the forex market's a relational market, so it's not just living in a vacuum, but we're comparing these numbers from one country to the next, and the British officials should take that into account. I mean, sure, their individual economic data affects them directly, and you can look at it as it's in a vacuum. But when you think about currency strength, okay, just remember that we all do this in comparison to one another. So what's a better alternative? Right now, it's not Europe. And then later this morning in the U.S., we're going to get factory orders and ISM non-manufacturing. All right, tomorrow we're going to have the Australian interest rate decision. Let's take a quick peek at the Aussie. Okay, Aussie just boom, settling right in there. I don't think we're going to see another reduction here like we got last time. They may sit steady for right now, but you never know. And if you back these out here, this looks like we could be seeing maybe a little bit of a consolidation here getting set up for the next move higher. So I'm going to say that about 101.75 is probably going to be decent support here for the Aussie, even if they don't raise rates tomorrow, or excuse me, lower rates tomorrow, which I don't expect that they will. So that's going to be a catalyst to move that one higher. We've got Swiss franc. Was it CPI coming in, all right, and they're expected to be seeing deflation now, and the rumors are starting to be floated here. You can see that on the 2-hour chart. You can see this huge spike here. I put this on the chart of the day, but there were some rumors that the SNB was going to move to negative interest rates. In other words, charge you to hold your money in Swiss francs as a way to try and weaken the franc. They've been hurt greatly in their exports by having a stronger Swiss franc due to flight to safety trade. So we're up here right just shy of this R2 pivot resistance under 124. All right, if the Swiss francs, if they have deflation worse than expected, okay, then they may start to think about some of these ways to encourage that inflation to happen for them. We're going to get the Bank of Canada interest rate decision. That's also going to be tomorrow. Let's look at dollar CAD. We saw that last week. We said we could approach parity. All right, I think this could be the week that we do it. All right, especially if the risk appetite continues in the market. They're not expected to change interest rates. They're at 1%. They're probably going to hang steady there. No reason for them to move ahead of what the U.S. is doing. We're going to get Eurozone GDP. Right, the Eurozone, right now, I'm not convinced that the economic data coming out in the Eurozone is really going to affect anything. They've got a much larger problem going on over there with the debt crisis. So if factory orders are down a little bit, or if GDP's down a little bit, or whatever, I don't think it matters too much. I think right now, with Draghi as the head of the ECB, all right, he's going to look towards easing rates to try and kickstart them out of that recession that they're facing. In the meantime, we're going to get the Euro heads, hopefully on Friday, who are going to come out with some better statements that are at least going to quell market fears. I mean, we know that this process is going to drag out over time, but what the markets need is confidence. All right, if bond vigilantes start attacking these bonds of these periphery countries, then the whole thing is going to unspiral, and it's going to be a disaster. So they need to make it seem like they're making progress, however it is they do that. And I don't pretend to know all the answers because I don't. Let's see, and then Wednesday is Australian GDP as well. We're going to get some more metrics from the UK, industrial manufacturing production. Those are due out. And we're going to get their GDP estimate, which could be interesting depending upon what the Bank of England thinks they're going to do here. Let's see what else is important this week. New Zealand interest rate decision. That's also on. That'll be Wednesday afternoon. Let's take a look at the Kiwi. We haven't seen them in a while, but Kiwi looks just like the Aussie, slightly biased higher, sitting just above 78 cents. I would say probably 77 cents is a good area of support here, and it doesn't look like they're going to do anything with their interest rate in New Zealand. All right, so everyone's just kind of sitting tight now, waiting, coasting into the end of the year to see what's going to happen in the Eurozone, because that's really what's the most important thing here. All right, obviously all these other countries have their own economies to manage, but it's the kind of thing where the euro debt crisis is really holding everybody back, because that could drag everybody into a global recession. That could set off a liquidity, a banking crisis, and people are just like, whoa, let's not make this any worse than it is. But if boom, they came out with a solution for this tomorrow, I think we'd see these markets a lot higher, and I think that's being reflected in the Santa Claus rally we're seeing in stocks and commodities. Let's look at oil. Where's oil? Back to 101. Oh, 102 on oil, yay. So I guess now we're supposed to cheer for higher oil prices, even though it's going to be more at the pump for us, because that means markets are doing well. So if that's what we have to do for the meantime, so be it. And let's see, Thursday then is the ECB and the Bank of England interest rate decision. Recall that the Bank of England does not issue a statement. The European Central Bank does. So we'll see what happens there. And then lastly, on Friday, we're going to get some Chinese figures, which could be interesting. So you want to keep an eye on the Aussie and the Kiwi with the Chinese data because they're affected the most. But industrial production, retail sales figures, and consumer price index from China, those are all going to be important. And that's really what it is to close into the end of the week with that Euro leaders meeting in Brussels. So it's amazing. Everything always seems to go down in Brussels too. But anyway, actually, my wife's going to be over there this week. How about that? So that's going to be an important meeting because we're going to need to hear some sort of answers, move towards progress, what's happening. But for now, I think markets are content to move higher. I don't think any of this individual data is going to derail the process, but really what's going to come out of the Eurozone is the most important. So keep an eye on the prize. We've got this slightly higher bias, but don't be afraid to fade the action, especially if something doesn't add up or if you hear something that's not right. So that's what I've got for today. Again, good trading to all.